right, I see you've made a forum. It's great to see the different countries represented here from all over the world. And I'd like to officially welcome you all to the inaugural CASI Afrique webinar. A warm welcome to our panelists, our participants, and our partners. My name is Rina Modoni. I'm the Executive Secretariat of CASI Afrique, and I'll be your moderator for the day. So just to begin, allow me just to share a few housekeeping notes that we can use throughout this session. The first one is please use the Q&A function on your screen to ask any question to our panelists and speakers. We also encourage you to engage and share your thoughts and comments in the chat section that we can make this an interactive and rich session. And then finally, we have measures in place to help us maintain the integrities of today's forum. So should we have any disturbance or mishap, please do bear with us as we try to restore order shortly. This webinar is brought to you by CASI Afrique. CASI Afrique is an initiative that optimizes Africa innovation and entrepreneurship ecosystem for large-scale job creation. We are currently doing this through various pillars, one of them being a knowledge hub, where we gather knowledge and insights to help the ecosystem of entrepreneurship. We also have an acceleration pillar where we're offering training, mentorship, and network opportunities for skill-ready entrepreneurs. And we have a think tank where our main focus is to also offer advisory and advocacy for these same entrepreneurs. So for today, with our experts and our various panelists, we want to explore whether it's time to rethink African scale-up. And scale up in the terms of financing. Whether you're an SME joining us today, an investor or a skill-ready SME, or simply you're interested in the dynamics of your business growth in Africa, this session will provide with you actionable insight to rethink and reimagine your approach for scaling. We are privileged to have an outstanding lineup of speakers with an extensive experience in entrepreneurship, innovation, and financing. And let me introduce them to you. We have with us today Gilbert Manirakeza, who is a seasoned entrepreneur and the founder of several businesses that have expanded continentally and attained global reach. One of these businesses is the Numa Group, a strategic communication agency that has presence in over 20 African markets. We also have Weza ProSoft, a development and marketing software company, which has also successfully scaled and established a strong presence in over 20 countries in Sub-Saharan. Gilbert is also proudly the co-founder of CASI Afrique and is one of the main reasons why we're also gathering here today. On the panelists, we also have Lois Ochanda, an international development professional with a distinguished career managing complex, multi-country research and development program across Sub-Saharan Africa. With sector expertise in development policy and education, Lois brings a unique blend of practical, research-based insights to advocate impactful initiatives. She also specializes in policy analysis, data government, ethical and responsible artificial intelligence, gender analysis, grant making, and donor relation. Lois is passionate about leveraging inclusive policy and innovative technologies to create equitable opportunities and drive transformative change globally. Lastly, we have Dean Gishuki, an accomplished marketing and business development expert with an extensive experience advising and working with startup, SMEs, and venture capitalist firms across Africa. Dean also serves as a business mentor at iLab Africa, an advisor at Strength Startup, where he works directly with early and growth stage companies, helping them overcome the key business challenges and refine their growth strategies and improve their products for the market fit. Dean is passionate for storytelling, building long-lasting brands, and he has carved out a unique niche of advisor, mentor, and strategist in Africa Dynamic Startup. This is the panelists we have for you today, and we're very excited for the session because we know, other than the big turnout, we do expect big things in terms of substance, in terms of interest, and in terms of influence. To kick things off, we'll have a keynote address from Gilbert. We'll set the stage for us for a discussion. Afterwards, we'll transition into a panel discussion where our speakers will share their unique insights and experiences. So let's begin, and I'll offer the floor to Gilbert.
Thanks, Rina. And I'm going to quickly share my slides. I have a couple of slides that I would like to run through, and great introduction, by the way. And I'm very honored to be here on this panel session with such illustrious colleagues. And essentially my discussion is going to be focused on highlighting some of the contextual aspects that we need to keep in mind as we talk about scale-up financing and SME financing in general. And this is a topic that I believe everyone is interested in for many reasons. One of the reasons being the fact that right now there is a huge crisis globally, and that's the crisis of job creation. Can you all see my slides? Rina, can you confirm that you can see?
Just a moment. Your screen is loading. Yes,
All
now I
right.
can.
All right. So why should we have this conversation today? My considered opinion, and I'm hoping that my distinguished panelists will agree, is that job creation has become an emergency. It has become an urgent imperative for the entire world. Now, for Africa, it is even quite urgent. Why? Because one, the demographics of Africa. We know that we'll have a population of 2.5 billion by 2050, which is very, very soon. But most importantly, we'll have 100 million young people entering the workforce this decade alone. And let's put that into perspective. 3 million young people coming into 3 million new jobs being created in Africa, but 12 million young people entering the market annually. Look at that gap, a gap of between 7 and 9 million of young people who come in without the jobs that they need to succeed in life. And this is happening with the backdrop of 23.6, actually, I would say 24 million plus jobs that need to be created even as we speak today. And this is not just an issue of statistics. We are starting to see serious unrest in various countries. And I'm not saying that all the unrest we've seen, all the protests we've seen in various African countries are due to job unemployment, if you will, or joblessness. But I would say it's one of the dimensions. There are other things that young people are asking for, such as good governance, but essentially that good governance, all these other things that young people are asking for as they go to the streets are tied to the kind of livelihoods they would like to have. They would like to ultimately have jobs and be able to afford healthcare and other benefits and be able to build a big future for themselves. And we don't see just unrest. We are actually seeing rising vulnerability across the board. We are seeing situations in some African regions where terrorist groups are recruiting young people, offering them a motorbike and say $15 to join a terrorist group. And when you have been sitting at home for 2-3 years without any prospect of a job, some of these propositions can be quite enticing for these young people. And we've seen this phenomenon growing quite a bit. And unfortunately, women and children are affected quite significantly by what we are seeing. This, in our considered view at CACI Afrique, and even in my own personal experience, means that we have to really, really pay attention to this issue of job creation. And when you ask yourself, where do jobs come from? The easy answer is SMEs. For the simple reason that they contribute roughly as much as 50% of the total GDP of Africa. 50%, half of the GDP of Africa is accounted for by SMEs. That's a huge number from a macroeconomic point of view. And also you also have to consider that 80% of all jobs across the continent are in this economic category, which is SMEs. And then also they account for 95% of registered businesses in sub-Saharan Africa specifically. So I guess the case I'm trying to make is we have to grow SMEs. We have to grow them so that we grow job creation, because we've seen that if we don't grow job creation, a lot more will happen, but not on the positive side. So now one of the critical factors for the scaling of SMEs is financing. There are other factors, but financing is a key one. And one might ask, what are some of the issues that are affecting financing of SMEs? Accessibility and affordability are the top two. In fact, according to statistics, an estimated 28.3% of firms, that is SMEs in the region, are constrained when it comes to credit. They are not able to get access to the credit they need, but also about up to a fifth of SMEs in the region, in sub-Saharan Africa specifically, don't have either access to a bank loan or a line of credit. And interest rates are another big problem when it comes to affordability. So accessibility is already a big problem, but affordability, even for those that are able to access credit, is a big problem. And obviously, when you run an SME, credit is probably the first door you knock on, because you might not necessarily know where to get some of these other funding mechanisms, but banks are everywhere, or microfinance institutions are everywhere. And talking of microfinance entities and maybe mobile lenders, their interest rates in some cases are even higher. They can even go up to 40 to 50% in Africa. So affordability is a huge problem, because if you make financing unaffordable, you obviously make the SMEs that need that kind of financing even more fragile, because they have to spend more money out of pocket to be able to sustain that kind of financing levels. So let's ask ourselves the question of what's happening with banking or bank financing. And here I don't necessarily have answers. I just have some highlights of some of the challenges we are seeing with these financing sources. So with banking, for example, we've seen a rise in risk aversion from banks, whereby they less than 20% of their loan portfolios are going to SMEs, including those that have been banking with them and that need to scale. And collateral requirements are a big problem, high interest rates, bureaucratic hurdles. You can imagine an SME having to wait 30, 40, 60 days to get a loan, because the average duration is about 30 days to actually get a loan. And it defeats the purpose, because many times when you have an opportunity to scale, maybe to export to a neighboring country, maybe you've gotten a contract, those opportunities they're not long term. They're things that you need to do in the next 15 to 20 days. So 30 days makes it very difficult. And obviously, long-term financing is a bit of a challenge, especially on the banking side of things. What are some of the other sources of financing and the issues that we have been seeing, and that some of you could easily Google, and you'll see, for example, the fact that venture capital, which is investment that provides capital to early stage companies with high growth potential, has been declining over the last few years. Well, mainly because of the high failure rate, and I would be very keen to hear my co-panelists' perspectives on why we have such high failure rates. But the rates have been quite high. And the funny thing is, we would have great companies, and I'll dare mention some of them. In Kenya, for example, we have Sandy. Nigeria, we have 54 Gene, fantastic brands that have raised millions in VC funding. And then 2 years later, they're shutting down, they're closing. And you wonder, why is this happening? And because of some of these failure rates, the VC investment category has been underperforming vis-a-vis other asset categories, including some market index funds. And obviously, when an asset category is underperforming the market, the mainstream market, it becomes a bit difficult to attract more investors into that category. So we've seen a decline there as well. Due diligence issues. Also, we've noticed issues such as herding behavior with VCs trying to get into the most trending sectors and not really doing enough due diligence because of that. And also, there's some challenges that we have to admit are very specific to Africa: limited capital availability, weak regulations in some sectors, infrastructure issues. And on the private equity side, we also have a high failure rate, but not as high as for VCs. But also we have underperformance generally, lack of transparency in some cases has been blamed on PE firms, but also we have operational challenges whereby PE firms, instead of coming in with a bigger package to support SMEs to grow, they actually just come with the money. And sometimes money is not enough, and probably we'll get into those discussions in a bit. And perhaps I can talk about a couple of other categories. We have impact investing, which has been growing steadily. Some of the issues that have been pointed out in various research papers include things like very low rates of deal closing, limited deal flows, issues measuring impact, managing impact, especially in Africa. And I'll be very keen to hear what my co-panelists think about that, specifically when it comes to not just impact investing, but also donor funding and development financing. Also, risk perception has been a bit of a challenge in Africa, as well as capacity building, including regulatory hurdles, which are actually quite cross-cutting. Scale-up investing, which is what we are specifically talking about here, but I consider that all these types of investing and financing can actually lead to the scaling up of sectors, of outcomes in different sectors, of the development of sectors and SMEs in those sectors. Because here we also have Lois, who's not necessarily on the business investing side, but on the development side. And the good thing about development investing and some forms of impact investing is that it creates the conducive environment to grow business sectors. And then scale-up investing has also had similar challenges, limited deal flow, exit challenges. And this is a very interesting one. Being able to exit from an investment is actually one of the things that motivates investors and funders to come in. Maybe not so much funders, but definitely investors. So there are some issues there: governance and transparency issues, access to finance, because scale-up investing is not just about giving all the money that the entity needs. If the business or the SME can't raise additional capital or day-to-day financing for other aspects of the business, it could actually be an issue. And obviously the regulatory environment. The blended financing category has risen in prominence over the last few years, whereby development organizations, international finance entities, or what is often called DFIs, have been coming into the commercial space to basically, they would bring cheap capital, give it to various entities such as microfinance institutions or banks, and tell them to lend this to their SME clients, but maybe at lower interest rates, in order to de-risk financing for these financial institutions. And this is something I would like to hear more about, because it's obviously a growing sector. We have institutions such as the Africa Guarantee Fund and others that are doing this type of blended finance, and it's actually working quite well, because it's de-risking, and when you de-risk for financial institutions and lenders, it helps SMEs and the SME sector generally. So I had planned to talk about Cassia Freak, but I would prefer to stop here because Cassia Freak, as Arina has already introduced, is focused on job creation. And I will be able to come in again and talk about how we view this particular topic of job creation from the perspective of financing, and what kind of financing we think might be interesting to consider. But generally speaking, if I'm to choose, if I'm to recommend, I would say that all the above, all of them should be relevant for Africa, because Africa, especially our SMEs, need as much funding, as much financing and investment access as possible. But it's just that some may be best suited for some types of SMEs in certain contexts and not others. So, Arina, allow me to stop there and hand over back to you.
Thank you, Gilbert. Thank you for that insightful presentation. Your remarks have set a powerful tone and emphasized that Africa stands at a pivotal point in economic entrepreneurship and job creation growth. While it's true that the continent has seen a significant increase in SME funding and innovation in recent years, as you have pointed out, scaling this business to the next level remains one of the most pressing challenges. And you have seen this from various reports and research. Let me now turn to our esteemed panelists to unpack how we can navigate this complexity of scaling and financing, and also some of the key factors that contribute to sustainable growth and investment readiness. I'll kick off and start with Lois. Lois, hi. So my first question posed to you is, having worked closely in grant making and donor relations, especially under IDRC, how do funding organizations evaluate and support early stage innovations to ensure that the potential for scale up and sustainable growth is there?
Thank you so much, Rina, and hello to everybody who's joining. So let me just start by saying that funders are different. They are quite different, and I'll start by situating my organization within that landscape of funders that are available. So it means you might have funders that receive their money from taxpayers, from parliamentarians, their foundations, and there are venture capitalists, as Gilbert started us off. So my organization is a government-funded agency, so that gives you a bit of a picture on how we expected to spend our funding. We receive parliamentary allocation, which means this is taxpayers' money. So if it is taxpayers' money, then we look at innovation from a public good perspective. And as a public good, it means it's supposed to be an innovation that benefits a wider public. So we do research for, we are a research for development organization, which means we do research that could lead to producing public goods, but at the same time informing public policy. So as a research funding organization, then we are also in the business of producing and sharing knowledge widely. So this introduction already points you to the kind of innovation process that we support. We look for innovations that aim at addressing societal challenges. Can you hear me, Rina?
Yes, I can.
Okay.
Please proceed.
Okay, great. So the kind of funding that we do are for projects that are expected to address some kind of societal challenge. And if you look at IDRC's current strategic plan that goes all the way to 2030, we have specific areas that we have identified as our strategic areas. And these are health, food systems and agriculture, climate action, and education. So the innovation, that we kind of support also need to be driven by certain values. So it's not just some commercial venture that people innovate in, but it has to be driven by certain values that are important for societal progress. For example, I work on AI, artificial intelligence for development. So we look at how can we harness artificial intelligence to address those values that I've mentioned earlier on. So agriculture, health, education, and things like that. So our driving or overriding principle, we talk about responsible artificial intelligence. And there's a reason that I underscore responsible artificial intelligence. This should be solutions that aim at harnessing artificial intelligence, but at the same time minimize any potential negative impacts of them. So for the grantees that we work with, they've come up with something with an acronym known as FACET, and this gives an idea on how do we evaluate projects that can be funded. If in the case of AI solutions, these are projects that are measured for their fairness, accountability, confidentiality. They have to be ethical, they have to be transparent and safe for use. So you asked, what levels do we support? You will recognize that for most public funders, they come in and support projects that do not necessarily still have commercial value, but they have the money that helps with the ideation. So we support projects right from the beginning, right from the ideation. So for example, recently, we have been supporting some projects in AI. If I give you an example of the education space, there has been a project at Maseno University that's trying to look at Kenya Sign Language and turning that from sign to audio. something like that. So you might not find a funder at this point that would like to put their money where they're going to, where the project still starts at collection of data and trying to test this thing. So even at that ideation stage, we support such projects, because remember, the goal is supporting societal challenges over and above all. So for me to end this first part, is something to keep in mind is that we fund from public money. So that points you that we support more of projects that address innovation as a public good, innovation that addresses societal challenges. Other values that we look at, it has to be inclusive and sustainable, as opposed to the commercial viability that it brings. If there's time, then I will come back later on to try and explain a little bit more on how IDRC actually funds these projects. Thank you, Rina, and back to you.
Thank you, Doris. Thank you for that perspective. It's good for our listeners to also understand how, from a public funded initiative, what should we consider. And now we'll move on to Dean, whereby we bring the private sector into this conversation. Dean, when you're working with venture capitalists and early stage companies, as we've heard from your bio, what are the top 3 key metrics that VCs prioritize when evaluating an SME for investment?
Yeah, thanks, Rina, and thanks to CACI-Afrique for having me. Looking forward to continuing the conversation. I'd say the top metric or thought process that investors look for is a bit of what Gilbert mentioned earlier, which is growth, and especially very extreme growth. It tends to be extremely unhealthy for most businesses to try to grow. An average expected number is 30% month over month. So that's about 2,300% every year. And what that does is that it does generate quite a bit of pressure on businesses, on economies, on ecosystems to try to sustain that. It's a bit easier to sustain over the first few years, where moving from 1 to 23 customers is technically 2,300%, right? But then moving from 23 to 500, from 500 to more than 10,000 and so on and so forth, it becomes a bit more difficult to sustain. We've seen some unique success when companies have and expand into wider markets, into 5, 10, 20 countries, especially if you're deploying a tech-only solution, right? Where you can launch in new countries without a lot of regulatory bottlenecks and ability to still acquire customers. Yeah, so that I think sets a big starting point for a lot of, I hope you can still hear me.
Yes, you're still audible.
Okay, yeah. Other interesting metrics are, for the first investment, most businesses are expected to hit at least $10,000 in monthly revenue as a starting point, especially when there isn't a lot of pedigree or experience in the team. And more, even with that experience, there's that expectation to hit that baseline in revenue and at least roughly 30% month over month growth. There's, of course, being in a market that is hot. And primarily, this is because most investors, similar to what Lois broke down around investing through other types of capital, there is a different source of capital where most venture capital firms do get capital from limited partners who get their sources from either pension funds and other larger investors, right? So they do have to sell the opportunity that the company is presenting, right? So there's a sense of a broker type relationship that venture capital funds have to execute. And that means that it becomes a lot harder to get excitement around industries that are not quote unquote hot or exciting right now. And that can generate very unfortunate cycles of the same companies getting funded when they are hot and when a sector is hot. And if a sector is considered not to be hot, then it's really, really difficult to get funding in. Yeah.
Thank you, Dean. Thank you, Dean, for that. It's good to also understand what is actually considered and prioritized. I'll now come to Gilbert. So Gilbert, Dean has brought about the aspect of numbers into this conversation and the element of striking the iron while it's hot in terms of funding. But we do understand that our entrepreneurs and our SMEs do face specific challenges. So I'd like to hear your perspective, considering and basing what Dean has just mentioned in terms of sustainable growth and sustainable scale up. When you consider the current financial debt and cross-border trading constraint in most African countries, how can SMEs scale more sustainably in Africa and also still maintain that attraction to investors, to donors, and to funders?
Thanks, Rina. So that's a very interesting question from the perspective of the entrepreneur, but also from the perspective of the would-be investor or funder. I kind of want to take a bit of a step back and look at Africa, like the sort of have a bird's eye view of Africa. So Africa, unfortunately, is a land of fragmentations. So the first fragmentation is geographic and historical. You have, say, 3 East African countries, Kenya, Uganda, Tanzania, that perhaps before weren't those 3 countries. You had communities from these 3 countries trading without a problem. There were no borders per se, but the moment the borders came into the picture, you started having 3 different economies, 3 different regulatory ecosystems. So an entrepreneur who is in Uganda and who has an opportunity or who has a product that they can sell in Tanzania has to face this fragmentation. So already there is a constraint that comes with that, because you can't just pick up and cross over the border and sell a product that could do very well across the border. So that's a key constraint that we have to think about. Now, luckily, over the years, we've had initiatives by governments to try and remove these fragmentations. We have regional economic communities that have been conceptualized, and you have the political arm of these regional economic communities. You've had things like freedom of movement of people, freedom of movement of goods, and things like that. And recently and increasingly, we're seeing things like SATAM, that is the Single African Air Transport Market, which are trying to solve this problem that essentially dates back to colonization. But this problem is a massive problem for an entrepreneur at a micro level, massive problem in terms of scale. And we are not even talking about an entrepreneur who sells very sophisticated products. I could just be, I have a very good friend of mine, fantastic entrepreneur who makes muesli that includes cashew nuts in that product. And when I was talking with her, she said that this muesli has about 3 different types of grains. So you have the nuts, and you have like oats and things like that. For each one, she has to get a license to export, although they are in the same product. And on the other side, in wherever she's exporting to, she has to get exactly the same thing. So she has a market. People want the product in these other countries, but exporting is so difficult. Now, if exporting is that difficult, financing will be all the more difficult. So that's a big hurdle that has to be overcome. So there is, on that particular front, an element of equipping entrepreneurs to be able to navigate the current regulatory system, because already that's a difficult thing for them to even understand, and many of them just give up on cross-border scaling altogether. So that's one intervention that can help to deal with that issue. Secondly, it's also to help governments understand the impact that this is having on their SMEs and SME ecosystems, and also to talk to some of these regional economic communities and explain to them that this is just not helping their cause. So geographic fragmentation is one. The other fragmentation, I would say, is the fragmentation of the financial ecosystem itself. So you have impact investors, you have banks, you have all these different people who are having resources for the same entrepreneur. But in Africa, I think we have to have a slightly different approach. When you are an entrepreneur today, you're being told you have to succeed, you have to give the numbers that Dean talked about, but also you have to be green, you have to be climate friendly. But also you have to be socially positive, so that you have to have all these things And one, you don't necessarily have the knowledge required to be all these things to begin with, because to run a green business, you need to understand that, you can't greenwash. So you need to understand how to be green and be able to tap into some of these funding opportunities. But at the same time, you need to be able to invest in things that will probably cost you more money than they bring a return. So there's this pressure on the entrepreneur to be this one solution for the many problems that the world is having, but the investment ecosystem is not like that. You have funders for climate, you have funders who are looking for impact, you have funders who are looking, so they are not one, they are like fragmented. So the entrepreneur is under so much pressure to be different things at the same time, and this creates a schizophrenic problem, because you have to be many things for too many people, and that in itself is not healthy for an entrepreneur. So this entrepreneur has to be a superhuman, and I think that is a bit of a challenge for the African entrepreneur. And my thinking would be that the investment financing ecosystem needs to look in the mirror, to have a look in the mirror, and maybe start thinking about building ecosystems in the US, you have places like MIT. MIT have something called the Office of Innovation, where they try to help their innovative ventures at MIT to build relationships with different types of funding, different types of stakeholders, and they make it easy for the entrepreneur. We don't really have that kind of facilitation in Africa, but we actually need to have this sorted out, because otherwise we are going to see more burnouts, we are going to see more confusion for the entrepreneur. The moment an entrepreneur gets this investment from investor X, this investor comes with so much pressure that it has to be green, it has to be socially impactful, and maybe they were lucky to get money from Lois, who is like, oh yeah, you have to show the public good here. Then it becomes very difficult for this, and often it's the funder, it's the co-founder or the co-founders or the founders who have to carry a lot of this strategic load, who have to be experts at many things. And in my view, that could explain in part the growing graveyard of African SMEs that after they receive funding. So I would say that just to narrow it down to what you asked, there is a huge opportunity for scaling up SMEs in Africa, absolutely huge. There is no place in the world that has the kind of opportunity we have in Africa. Our demographics are on the right trajectory, in terms of not just in terms of the active population of young people, but even the middle class is growing. So this is the right place to be today for any investor. But if some of these fragmentations are not addressed, if there is no shift in how investors and funders are thinking about the entrepreneur, but not just about the entrepreneur, but the environment the entrepreneur operates in such a way to be more holistic in their support, I think this potential is not going to be realized, unfortunately. But I'm hopeful. So I think it will. I think people are waking up, and that's why CACI Afrique exists. But essentially, it's going to be a huge challenge.
Thank you, Gilbert. Thank you. You have literally called us to go back and reflect on the direction you want to take Africa with. Before I go to the next question, I just want to remind our participants, please use the Q&A function to share your question, and we'll make sure before the end of the session, we direct them to our panelists, and we can have as many questions as possible, so that at least by the time we're leaving here, we've addressed all your concerns. I'll bring the conversation back to Lois. Gilbert has raised and rather tasked investors and funders to do some reflection and consider the dynamism when it comes to how entrepreneurs function and the different contexts in Africa. And one of the key things we see and we have been hearing about is around collaboration. And would like to ideally hear your insights on collaboration. And my question posed to you would be, how do funding organizations like IDRC work with local businesses, government, institutions to ensure that funding strategies align with the unique challenges and opportunities within the different African contexts?
Thank you, Rina. Indeed, I think this space is really as complex as Gilbert has painted it. So let me just start by saying that. So he mentioned about the diminishing donor, funding, and donors also depend on the political environment, on prevailing political environment, and you know how unstable that can be. So one day there's a priority, there's a new government with a certain priority. And then out of the blues, there's another government with a different priorities. And we have to shift along those priorities and changing political environment and priorities. So that becomes really difficult to adapt to, which is not necessarily aligned to the entrepreneurs' trajectory from where they started. They thought maybe in 3 years' time, there'd be money coming from IDRC to fund this, and then suddenly government has changed priorities. So those are things that we really should be aware of, that priorities change, especially for public funding agencies, that they're part of their mandate is to advance government priorities. Now, just coming to the kind of collaborations that are done generally with public funding agencies. And from the IDRC's perspective, it's really critical that projects are southern-led by local partners. It means that the local partners know know the content, they know the context, and they know what the priorities within that context will be. If you talk about artificial intelligence, for example, the priorities of artificial intelligence in the developed nations are not our priorities in Kenya, for example. So it means it makes sense that local partners identify their projects and lead them. So this determines the kind of partnerships that we have. The first one is with governments. And I'll tell you about a project which currently works with a National Research Fund, if some of you have heard about National Research Fund, because the NRF brings together the overall research agenda for the country. So our entry point in working with governments would be to collaborate with NRF, because we might give funding to NRF, and then NRF decides what are the priorities where they need to apportion their funding. That's collaborating with government funding agency on one end. The second one, Gilbert spoke about the policy and regulatory environment. So some of our research is expected to inform the policy environment. I'll still come back to AI because this is the space that I work on. It's a new space that's just evolving, and we need to understand what kind of policy and regulatory environment would be suitable for AI to thrive in Kenya. So we have a project with Strapmo that's actually looking at the AI environment, AI regulatory and policy environment. And some of our partners are part of the team that is actually writing the AI strategy. So Kenya has come up with a startup, I think it was a startup something, but we need to think about now that they are startups and they are very closely linked with AI, what kind of policy environment do we need for that? So that comes at the point of our collaboration with government. So it's government's own research priority, at the same time having local partners that can actually contribute to policy environment. The other group of people that we collaborate with are universities, and universities for obvious reasons. Universities are research and testing grounds, and many universities now have labs and incubation centers. I mentioned at the beginning that we try to look at projects that would be addressing societal challenges, and we look at that aspect of a public good. So it just makes sense that we collaborate with universities, and universities will find their partners. We expect universities, for example, to link with the private sector. And if you look at private sector in Kenya, who are they? They're the micro and small and medium-sized enterprises. Those are the majority, according to the introduction of this conversation. So those universities, when they look at how do they collaborate with businesses, we expect them to establish their partnerships with businesses and the other people that they work with. So in terms of collaboration with private sector, we also go with universities and researchers as intermediary partners. So our collaborations are quite diverse. They start from governments, they go through universities and research institutes, and to an extent, we want to see that the work that we are supporting contributes to private sector development. Thanks, Rina.
Thank you, Lois. Given that we are still in the collaboration discussion, I'd like to pose a follow-up question to Gilbert. You did a presentation and you did highlight around the aspect of failure rates when it comes to entrepreneurs. And we have seen this become a very big challenge and concern for all stakeholders within the spectrum of SMEs financing. So how can these stakeholders effectively support African SMEs to scale sustainably while yet reducing this failure rate for the funded enterprises?
Thanks, Rina. And just to say that I'm really appreciating some of the insights I'm getting from our co-panelists, and also to commend IDRC's focus on Southern-led initiatives supporting entities and initiatives that know the context and the local priorities. This is really important, and it goes into the question you're asking. At CACI-Afrique, we've done some initial research that has shown that the failure rates are multifaceted, or the causes of failures are multifaceted. The first level of failure is the ability of the entrepreneur or the entrepreneurs themselves to scale or keep a venture alive, if you will. And scaling a venture is different from creating one. It's fairly easy to create a business. Dean, I don't know if you agree, but starting up is fairly easy. But keeping a venture in business, and especially scaling it up, is a completely different ballgame. You actually need to become a different person at each one of the stages. The person you are when you start the business is not the person you need to be when it's time to scale it. Because when you have to build teams, when you have to recruit, to build a management team, when you have to, because when you are starting, you just, you wing it. You just do whatever you can, get some money from your parents and from your friends, and okay, now the business exists. But now when it comes to scaling it across the border, scaling it in other regions, bringing more teams into place, you need a culture. You need to understand HR. You need to understand taxation. You need to understand financing, different types of financing, the different levels of financing. You need to understand how to get the financing, how to do a proposal for IDRC to consider maybe your research initiative or your AI initiative, and how to, and that piece of the knowledge and the capability of the entrepreneur, in my view, should be prioritized across the board by all stakeholders, including investors and other development partners, simply because the complexity and the specificity of the African context is such that there's a lot of data points we just don't have. We don't have as much data in Africa and as much research in Africa done across different sectors. Today, if you're in agriculture, let's say you want to do something with cassava, it will be very difficult to get market-specific data about cassava that allows you to make certain business decisions. So you have to come up with a proxy for it, or you have to have a way to navigate that lack of data to fill that gap. So that's something that tends to be on the shoulders of the entrepreneur. But if entities, and I know obviously entities like IDRC are filling this research gap, but if we have more of this, even coming in from the funding institutions, including banks and VCs and all these people prioritizing that data provision, that skilling and tooling of the entrepreneur, I think we will start seeing some significant improvements. And at CACI-Afrique, we have a very strong knowledge management, knowledge generation arm that is going to be generating knowledge for different sectors, different categories of entrepreneurs, because we have realized that this is necessary, and we are not doing this theoretically, because all the entrepreneurs that we've been talking to in our surveys have actually identified this as a challenge. And myself as an entrepreneur, I've experienced this, continue to experience this in the various processes for scaling. And the second aspect is really around so there's that knowledge management and knowledge generation and data and so forth. The second one is obviously the training. Like I mentioned a few seconds ago, you don't automatically become a financial strategist. But when you are scaling, you have to think about what your finances should be. You have to project. You have to become your skills level have to go up. And sometimes you can say, okay, I'll hire experts to do it. Yes, but still the entrepreneur has to have the vision. And that's why in other parts of the world, there are CEOs who specifically are hired for the growth stage of a company. But in many cases in Africa, the founder will end up continuing to be the scale-up CEO. And sometimes they're just not equipped for that. And in Africa, we don't necessarily have African inbuilt executive cadres who are specialized in scaling, especially blitz scaling, which is what many VCs or funders are looking for, like Dean explained, simply because the rates of growth they're asking for require such high levels of expertise, especially at management level, that most founders don't have. So we have a curriculum at Classe Afrique that is addressing this, basically taking these executive teams of SMEs that are growth ready through a very robust training program that at the end of which they are equipped to start being that visionary growth ready leader. And that's a very important consideration when it comes to growth and scale, and avoiding failure rates that we have been seeing. The third one comes back to what Lois was just pointing at, which is policy. And that's a broad term, but policy has many different elements. So you have policies, you have laws that fall under different policies. That under each laws under each law you have a regulation, and you have institutions and so forth. Now in Africa, it seems like we have lots of policies, high level, beautiful documents, but the implementation is often problematic. And you can see this in the various free trade area agreements. AFCFTA is a beautiful thing. We all talk about it, but in most countries, it's just a policy thing that the government has signed. They haven't enacted the laws that will allow the actual entrepreneurs to trade in that regime. We've seen some countries pushing, we've seen some things between Nigeria and South Africa, but it's too slow. And I don't think Africa can afford to wait, because every day you wait in the life of an entrepreneur is critical. So there is also that aspect of policy, helping policymakers to get it right. I think the frameworks are good, but now, getting the research done in some cases is important, because sometimes you have to inform those policies. And that's why I get very excited about research, policy-oriented research. But beyond policy-oriented research, there's also action research and other types of knowledge generation that are directed at policymakers so that they can create those institutions, change those regulations, et cetera, et cetera. I mean, and this might be in very interesting fields. So for example, if I want to import, in Kenya, we don't have shea butter. But a few weeks ago when we were in China under Classe Afrique, we met fantastic entrepreneurs from Ghana and Cote d'Ivoire producing amazing shea butter-based products. But I know, Rina, yourself, and I'm sure Alois, you love shea butter products. But they are very expensive here if you find them. Many people, whenever I travel to West Africa, will tell me, oh, can you bring me some shea butter? And you wonder why. There is a direct flight from Abidjan to Nairobi. So, but then you'll find that maybe the costs of that transport is very high. And when you dig deep, you find out why is the cost for cargo so high on that that airline, you realize that taxes and charges are like 30%. And so so something like that kind of policy stance is affecting an entrepreneur in an African country who could get access to a market in Africa. But instead, we are going to places like China and the US to find markets that we have right here, because we have close to half a billion middle-class consumers in Africa, 500 million consumers in Africa. That is a staggering number. We can fund a lot of the SMEs just with the consumption from those people, but the fragmentation, as I mentioned, is a challenge. And at Casse Afrique, we are trying to build the body of knowledge that will go into what you mentioned, the advocacy and the advisory, hopefully, to drive progressively but incrementally those failure rates down, because the failure of an entrepreneurial venture is not caused by just one thing. It's usually a series of things. The beauty is we have amazing entrepreneurs in Africa, very resilient. They are already doing things in very tough conditions. If we just intervened on these different areas, I think we will be unstoppable.
Thank you, Gilbert, for that. I'm sure our audience is fully intrigued by how this conversation is going, but I'd like to slightly bring it back to Dean. So Dean, today we have actually started looking and reflecting on how things are done around the entrepreneurship ecosystem. And I know starting a business is, as you said, is easy and straightforward, and scaling successfully presents the key challenge. And today our investors, having been tasked to look at the strategies, their approach, and their policies when it comes to Africa, and SMEs having gained insights about how the funding ecosystem and investment works, could you please just share advice to our audience today and looking into the overall journey of them scaling even across and outside Africa? How can both parties, the funder and the SMEs who's receiving the funding, ensure and remain aligned in a collaborative manner that even as they're receiving this funding and taking it to the next step, that the company is scaling and still aligning with what was agreed upon?
Yeah, that's a great question. It's a unique challenge, especially once you survive the first few years of trying to set up a good foundation, and then you can finally take a short breather and explore what scaling and growing into larger markets might look like. Uniquely, I think there's a much heavier responsibility on entrepreneurs to essentially set the foundation that allows a company to grow and scale into new markets. And oftentimes, I do personally consider entrepreneurs to have to frame and structure that journey also for investors and for funders. And I think Lois mentioned really effectively and really well that at the end of the day, they do have certain requirements and certain responsibilities they have to meet towards the people who are putting up capital and putting up opportunity that the entrepreneurs have to come through and deliver on, right? And by and large, while the intro for most entrepreneurs tends to be very, very full, it's an additional responsibility on top of that, right? Where they are able to lead themselves, lead their company, and lead the investors into where they think opportunity lies, right, for the business, and specifically which markets, which technologies, which opportunities would be interesting enough to generate a good enough return, dependent on what return is viable and valuable to the investors, right? Whether it's an impact return, whether it's a financial return, sometimes it's a bit of both, and being able to lead the organization down that path. I think a really critical step one is just accepting that unfortunately, no one is coming to save you per se, but people might come along and support and assist, right? But at the end of the day, you have to accept that the crown is heavy, right? But hopefully the journey will be worth it, right? And the value and the solutions that you're able to bring into the market will be worth the difficulty. And hopefully, I think what that does is that it creates a more realistic interaction between investors, entrepreneurs, and the market, where entrepreneurs understand, in as much as there's this whole ecosystem around you to support you and to help you, at the end of the day, the buck stops with you. At the end of the day, it's your signature on the dotted line, right? At the end of the day, you hire and you fire. And what I've seen that do to founders that I work with, and to be honest, even myself as a founder, is it becomes a bit easier to accept that responsibility where you know there's no one coming to save you. And oftentimes you're able to lead better towards the promised land. Unfortunately, young entrepreneurs, and even myself when I was much younger, the impression is that when someone has money, has capital, they tend to also have the ability to really help you execute on that. And that's not exactly what that model is built for. And to be honest, across most capital types, whether venture capital, whether impact, even private equity in certain instances, right? Where the private equity organization has a smaller portion of ownership in the company, right? They rarely have the ability to dive into the management and execution. And while that is, I would imagine, not what most entrepreneurs would like to hear, because it's already a really lonely journey. It's a very painful journey. And what I'm basically saying, oh no, that's not enough. It's about to get even more painful. What I hope that does is that it becomes a bit easier to accept and come along for the journey with full understanding of what it's going to look like in a few years' time, right? It's not going to be easier, but hopefully you'll get stronger and you'll get better at understanding what you need to plug into the business. And over time, I think what it does is that people step up to the plate, they level up, they research, they study, they improve themselves and push themselves to the level where they are able to chart those paths. And in expanding in new markets, it's, I think, important to not make certain critical errors really early. One of the biggest ones being able to entertain new markets, being able to have a corporate structure that allows you to start businesses in multiple markets. That is hopefully not too painful. A few key starting points is registering a holding company in the right jurisdictions. So in Africa, whether it's Mauritius, whether it's Dubai, whether it's Delaware, or whether it's within some of the economic free zones that exist within Africa, at least having a good sense of what might work for different markets and different countries, so that even when you do need to make that decision, it's a bit easier. To make it even more interesting, learning different languages and culture and starting that much earlier than you'd anticipate, so that when you do get to the point of, let's say, expanding into Nigeria or expanding into Mali, I can see Gilbert has unmuted because that's probably something he's very familiar with. You are able to execute that and jump into that without having to have very short turnaround times and a ton of short-term pressure. Gilbert?
No, actually, there's something else I wanted you to touch on. Rina, you grant me permission because I'm very curious about a couple of things. One for you, Dean, and one for you, Lois. For you, Dean, we've had a conversation about entrepreneurs vetting investors. I would really want you to talk a little bit about that, because I think that's not talked enough about, but not all investors should be taken on by entrepreneurs. So just to get a sense of what that looks like. And Lois, since you are our AI guru, this topic is very massive, and it has massive implications. And I feel like maybe AI can help us figure it out, in terms of just helping us crunch the data and the insights needed to steer different countries, different entrepreneurs in the right direction. So basically the question is, could AI help the entrepreneurial ecosystem generally, but also the policy ecosystem and the university ecosystems, because we have to move fast, and the continent is big, and it doesn't seem like there is any other technology out there that can help to solve and navigate these complexities. Sorry, Rina, I'm just curious, and these are genuine questions. But I promise you won't get any other misbehavior from me.
Yeah, that's a great question. I think, and it's such a great conversation to have. And uniquely, I think investors appreciate it even more because they want to work with founders who deeply understand what it's like working with them, right? So the first layer is, I think every entrepreneur, every business needs to understand the journey it's on. So what does growth look like? What does impact look like? And what's the best type of funding that they are likely to succeed with, right? And oftentimes the desire across most entrepreneurs is getting money no matter the type, right? And no matter the structure. And while that works in the short term, it often bugs you in the long term. Then second, once you do understand the capital class, whether it's venture capital, private equity, debt, family and friends, impact, and so on, it becomes, I think, important to figure out who are the players who are most likely to understand the journey you're on. And oftentimes, especially in VC, you pitch between 60 to sometimes 90 different investors and end up with about 3 to 5, right? Which is very skewed. But often what you find is that those 3 to 5 were essentially the people you should have just started with, right? Because they have domain expertise in what you're trying to do. They understand the opportunity. They've sometimes made a bit of money in that opportunity. They have the relationships that you need in terms of talent and so on that you can leverage on, right? And the rest of the 85 were essentially just trying to improve how to pitch. It was mostly learning, not specifically pitching to get funding and financing. And often what that results in is that on both sides, on the investor side and the founder side, there's a lot of wasted energy and people talking to each other who traditionally or who ideally should not be talking to each other, right? And then finally, when it comes to the due diligence step, which is a large part of the conversation we had with Gilbert, was how do you ensure that the investor you're talking to is able to jump on this journey with you, right? And it speaks to my earlier point around you managing the investor. It's primarily understanding that at the end of the day, it's your name on the dotted line. At the end of the day, it's you who incorporates the company, who starts the company, and who sells to the customer, right? So as you bring investors on board, you have to understand that they have their own responsibilities that are not always directly related to your responsibilities. And you do have to understand and accept that as a reality of life, right? And as you do due diligence, of course, you go out, speak to other investors that they've worked with, other entrepreneurs that they've invested in. What was that relationship like? What went well? What did not go so well? And I wouldn't consider it to be exclusively as a yes or no type decision. It's primarily as a framing of the opportunity of, I still want to work with this investor. They did this bad behavior with so-and-so and this other bad behavior with so-and-so, but they also had these 10 other instances of good behavior with these 10 other people. So how do I manage this working relationship? What do they primarily focus on? What do they really look at? What do they really get concerned around? And what are they able to accept and move on from, right? And it becomes, I think, a much healthier working relationship. And in some unique ways, a few of you might have noticed, it sounds a lot like dating, right? It's a lot like dating, where you try to understand, who is this person? Do I want to marry them? Can we go on a few dates? Can we get to know each other? Do I love them? Do they love me? And can we work together for 5-10 years? And hopefully it creates, I think, a better relationship, a less confrontational relationship between investors and sources of capital and entrepreneurs who need it.
Do you want me to come in, Rina?
Yes, please proceed.
Okay. So I would just like to comment on 3 things, and then I can come to the AI question. And the first one is, I'm really impressed that Cassie Afrique.
Yes.
Cassie Afrique has embedded knowledge generation. I think this is absolutely critical, including for entrepreneurs. Just trying to bring in the research element and not just doing things, because if you're doing things, you want to understand, why are they working in the way that they're working? Why am I receiving positive results, and why are there certain obstacles? So I think it's useful that even for entrepreneurs, they need to understand the reason why something is working, and harness that and leverage it, and look at how do you manage the risk. And this involves a lot of thinking. And why this is even useful for you is because you're embedded in practice. So it makes it easier to understand. compared to maybe someone who's just in the university and applying the theories. They might not adequately have the practical implication of things. I think it's also harder for entrepreneurs to do both, that you're trying to research and understand, but at the same time, you're trying to practice your things. So that's why I said at the beginning that among the collaborations, if you can find how to engage with the universities, I think it's something worth considering. There's lots of research that is always done around entrepreneurship. So I find there's just value in trying to engage with researchers. So if you can embed research for your organization, I think it helps in that thinking process and trying to manage things. The other one was to do with how funders are also sort of fragmented. And I look at it that the funders are most likely forced to take certain directions. I was just mentioning our strategic plan. So for a period, we had a certain strategic plan that paid attention to certain things. For the past, now we have a 10-year strategic plan, and every time you're funding a project, there's a question. So we appraise projects and we are asked, how does this project contribute to the strategic plan? So it means we are boxed to be in that, to align with the strategic plan. So if you had an exciting idea, which is outside the strategic plans, then it becomes very difficult for me, for example, to justify why this is an exciting idea and we need funding, but you will be told, how does it align? So I think for entrepreneurs, it becomes critical that you adapt to the different funders. So it helps that you can map out the different funders. So this is a public organization. It's likely that they'll be funding things that are more of on the public good. This is a foundation. For example, you have MasterCard Foundation, and they support a lot on youth employment and things around that. So you know that there's MasterCard Foundation. And then you have another organization that probably does impact funding. So you know these guys do impact funding. So there's value for entrepreneurs to map out and see what the areas of interest for those people are. The other one, Gilbert, you mentioned how implementation of policies become problematic. So there would be research and they inform policies, and we always told, for example, in Kenya, we have these beautiful policies, implementation is a problem. The other problem is fragmentation. So there's something called externalization of policy making, which is very rampant in Africa. So there's a donor who is now supporting the development of AI policy, and we run with that one and forget that we had a data protection policy and we had an AI, an ICT master plan, and we don't tie this together because right now there's money in AI strategy and AI policy making. But I think there's value in entrepreneurs finding a way to organize themselves to influence that policy. Because policy making in agenda setting, you know, if you think about the policy making cycle, there are opportunities where external stakeholders also intervene. So they could be in this agenda setting, they could be in advocacy, for example. So I think it's critical for entrepreneurs to also find opportunities and organize themselves in a way that they can influence policy to sort of, to an extent, work in their favor. Now, when it comes to AI, I'm a techno optimist, and AI obviously has this group of people that, oh, AI is going to take away our jobs. AI is an Armageddon. It's going to finish us, and all of these stories. But I'm on the techno optimist in that I always feel that technology is meant to make things more efficient. Think about the meeting we are having now. If there was no technology, we'd have to look at how to bring people from Zambia to Kenya. So I see technology, I always look at the positive side of technology without, and I don't forget that potentially it has negative implications for it. So for I think this is a moment for Africa to look at how do you harness AI? Because there are very many good things about it. That's number one. There are very many good things that we can harness for many things that we are doing and in different sectors, whether it's be in business. whether it is government services itself. There are very many opportunities that AI can offer. And I think we need to concentrate on that part. How do we harness AI? Why? Because we are always being left behind in Africa, right from the very first industrialization. Even if you think about agrarian revolution, we're still digging with hoes in Africa. Several years later, when agriculture has been mechanized. So we have been left behind a lot. So for me, it's looking at how do you harness AI? And I think it's a question that entrepreneurs should be having in their minds. There's no way we can ignore it. It's here with us. It has benefits. How do you harness those benefits? For example, there's a lot of automation that's going on right now. So we cannot continue insisting on doing things manually. There, if you think about businesses, even as basic as e-commerce, it is becoming possible because AI is recommending things for us. And how can it recommend things for you? How can you use it in your favor? If people talk about jobs changing, for me, there are more jobs that are growing. I'll give you a quick example. I met this young lady sometime in a holiday, and I asked her what she's doing with herself, and she says she has established a company, a digital marketing company that even for you, Gilbert, you probably have your website, you have your Instagram page, you have your TikTok page, you have your LinkedIn page, and you need someone to post for you on those spaces. She has established a company where you'll be in this webinar, you have picked your key points, but after this, you're going to be busy with something else. So what do? You take your points, you've taken your pictures, and she'll write that for you, bring that for you, and then you review, and then it is posted. So someone is actually managing that for you. This job was not there earlier on. So someone can actually establish their own companies to do that. So I would look at the positive, the contribution that AI can make for you, even as we look at the challenges that we have had in the past. How is AI making that easier for us at this point? If it's not, then how can it? So for me, I'm more on the technology policy part of things, and I'm looking at how can policies enable AI development and use. So that idea is already there. So if you also think about funding, there's a lot of funding that's right now has come around because of the excitement around AI. So how do you tap on that? Yeah, how do you tap in those spaces? So in brief, I'm a techno optimist, and I think there's a lot. There's right now we can't imagine the end of AI. We can't imagine the end of possibilities for AI. Right now, if you want to generate your business plan, you'll go to ChatGPT, and then you can edit it from there. So there's something that has started it off for you, and you can edit it. If you want to write something nice, you'll use an AI tool. It will generate for you, and then you edit the points to suit what you're making. So I would encourage you, as who are here, to really think around, this is the reality now. AI is a reality. How do we make the best of it? Thanks, Rina.
Thank you, Doris. I know if we start the conversation on AI, we need 2 more sessions just to unpack that specific topic and how it can also be leveraged both for the investors and other stakeholders in the ecosystem. In the interest of time, ladies and gentlemen, we have had some very valuable conversation from our panelists, and they have shed light into today's topic, but would also like to hear from you and actually just answer a few of your questions, because I've seen there are some that have been shared on the question function box. And I will start with the first one, posed to Dean. Dean, is this for you from Jojo? She says that in one of your posts, you mentioned you've had 2 business exits. How did you know it was time to exit? And what were some of the things you considered before you did that?
Yeah, that's a great question. Yeah, so I've had a recent business exit. I think it was a fairly I don't want to say easy, but it made a lot of sense. It was a business that had been active for quite a while, but wasn't as operational as it used to be. And there was a unique opportunity to exit, which was much easier than most times when you're already building the business and really active on it. I'd say for the most part, it depends on the type of business that you'd like to build and maybe eventually exit. Oftentimes, founders want to build and run forever businesses. You want to build something that you do for the next 5, 10, 20, 40, 50 years. And while that is exciting, and to be honest, even for me at the beginning was the initial goal, you do evolve. And as Gilbert mentioned, you do change into different types of founders at different stages of the company. And sometimes the opportunity comes up that makes sense to leave and help someone else grow it as you explore the opportunities. I'd say for the most part, as an entrepreneur, you don't have to marry your business for 20, 30, 40 years. I do not endorse forced divorce, but it is sometimes necessary to step away and work on other things. And the hope is that you do find a partner who has similar beliefs that you did when starting and running the business, that is able to continue what you started, right? And maybe even take you to places that you individually might not have been able to. I'd say the biggest considerations are, of course, how much money you might get for it, but also whether they are able to continue on the path that you had set, and whether you're able to transition in a fairly seamless and comfortable way for everyone involved, including the employees, the customers, and of course the investors/acquirer.
Thank you, Dean. Thank you for that. This is a twofold question segment, and I'll assign the first part to Lois and the other part to Gilbert. So Lois, this is on to you. How can alternative funding mechanism, especially, for example, crowdfunding, grants, diaspora bonds, be leveraged by African diaspora to reduce reliance on high interest credit for businesses and community projects?
Rina, I'll confess that I'm not well suited to answer that question. Coming from a public funding body, at the beginning, at the introduction, I mentioned how funding from a public agency. I'll give the example of National Research Fund in Kenya. So that's where the government concentrates its funding, and such kind of funding is to take on innovations or areas of technologies which commercial funders would not be interested in. So this early stage funding is what public funding agencies would be laying their funds, if you like. But I think maybe one of my colleagues, panelist colleagues, would be better suited to do a more comprehensive justice to that question.
Yes, I'll open the floor to any of our panelists who wish to address that. Let me repeat the question if it wasn't clear. Yes.
No, Rina, it was quite quite clear, and I won't take much time on this one. I think those alternative investment models such as crowdfunding and the other ones you mentioned, particularly because you mentioned diaspora, but it's not just diaspora who should be considering that. I think any entrepreneur that has a project that can, say, for example, raise money through crowdfunding should definitely go for that. One, it's free. It's free capital. It's free investment. You don't pay any interest on crowdfunding resources. Obviously, you have to offer either an advanced version of your product, or obviously each type of funding has its own conditions and its own behavior. So as long as you can deal with that, I think you should definitely go for it. The bottom of the bottom line should be go for the funding source that is best suited for your needs and for your trajectory, like Dean has been telling us. Costs may not always and should not be the only consideration. I think there are other considerations. You should look at it holistically. I don't think there is any funding or investment type that comes without any strings attached, so to speak. There is always something you have to give in return, whether it's impact, whether it's a development outcome, if it's in the case of development institutions like what Lois was just saying now. You should treat each one on a case-by-case basis. And just to mention, an additional point to what Dean was just saying now, I have turned down 2 acquisition proposals for 2 different separate reasons. So you will get proposals for acquisition, and sometimes it will be tempting. But in the first case, there was a mismatch in visions. And there was, in good conscience, it was going to be very difficult for me to say yes. In the second case, it was more of the financial offer that was made. Well, not the financial amount, but the structure, because you also have to look at that. How they want to pay the earnouts. It gets a bit technical, so you would get assistance from different people. But you have to look at all these things. The thing is, don't let anyone rush you into a decision. If someone is trying to rush you into a decision, that's a red flag. Take your time, take the time you need. Most importantly, get expert advice as much as you can. There's a growing class of mergers and acquisition lawyers in many countries. Look those up, and inside CACI Afrique we'll be bringing these experts so that our entrepreneurial network has easier access to such expertise. I have to admit that there are still very few across the board in Africa, and that's why we want to bring them in one place so that even people in different countries can be able to reach out to them and get their expertise. It's very, very important to have someone who is a professional to look at the terms of the term sheet or the acquisition, purchasing contract, whatever it is. Because without that expertise, you can find yourself being very exposed and signing things that will tie you down for a long time, or that could expose you to losing chunks of the monies that you are entitled to, etc., etc. Yeah, I just wanted to throw that in. Back to you, Rina.
Thank you, Gilbert. I'll pose this second part to Dean. It's still from the same attendees, but they're asking, what strategies of financial product can be developed to address the challenge posed by high credit rates, making it easier for entrepreneurs and organizations to access sustainable project financing?
Yeah, and I think there's an element connected to that around the cost of debt in Africa. And often the challenge is that the cost of debt isn't generally tied to your business or the economic opportunity within the market, but it's primarily tied to the potential result from other, let me say, financing and interest sources, right? So you're not competing against another business to get a good loan. You're competing against oftentimes government bonds, right? To get a loan. And especially that tends to be the case in Kenya. And I'd say if an entrepreneur first is able to accept that, you realize that a lot of credit sources tend to be really expensive. And you're almost always in an unfortunate position where you're trying to out-earn an ecosystem that you have little control over. I'd say for the most part, accessing really affordable sources of capital as much as you can. Oftentimes, this tends to be credit unions, family and friends, especially prior to you setting a good foundation and understanding the financial health of your business as a starting point, right? And it becomes a bit easier to understand the rules of other capital sources. So for example, if you get a bank loan, maybe you need to repay 20, sometimes 30% a year. How much more return does the business have to generate at a percentage level every year to justify that type of credit, right? Do you need to generate 300%, maybe 500% return every year so that you're able to pay 10% or less to your capital sources, right? Is that even possible? Have you been able to do that at a smaller portion of your business? And then in terms of new credit models, sometimes there's very little new under the sun. It tends to be just the same thing repackaged, which I think is a good thing. I think the SACCO ecosystem and the credit union ecosystem has been very useful for a lot of entrepreneurs for a long time. Smaller or different versions of family and friends. Everyone says that, yes, my family is difficult to work with and get money from them. But instead of going to one member and taking the full amount, let's say $50,000, what if you go to 30 or 50 friends and get $1,000 each, and try to reduce the per person risk, if I can call it that. Yeah, and essentially increasing your ability to be flexible across the credit ecosystem that is available to you. But the biggest thing I'd say, connected to a bit of what Gilbert said, try not to lock yourself a bit too early, especially if you're still figuring out what the business is. Try to explore different models to give yourself and your capital sources breathing space before you go the traditional, especially bank loan path that can sometimes be a bit predatory. Primarily because they are taking a significant risk on you. They don't have to take as big a risk in other sources of return, whether it's government bonds, whether it's money market funds, and so on and so forth, right? Those are almost guaranteed risks. So they're taking a big risk for you to invest in you and to give you money, right? So you also have to accept and acknowledge that they might not be the best source of capital and credit for you, especially really early on. In terms of other sources of credit, other sources of financing, they're not always credit, so I won't speak too heavily on that.
Thank you, Dane. I see we're slightly out of time. It's very clear that we need several sessions just to unpack this topic, but I believe that our audience have really captured and grabbed something. And today, having understood and examined the financial ecosystem and ensuring that SMEs are better equipped to scale and attract investors and investors and funders themselves are also doing the reflection and seeing how do they adapt or rather restructure their approach and strategies. And thank you, dear listeners, for the engaging questions to our speakers. It has been insightful for them to give you answers and engage with you. And as we come to an end, I would like us to end the session on a lighter note. I'm sure being the first time we engage in our speakers, it's best to also find out and hear more from them. So I'll start off with Gilbert. Gilbert, we heard from your bio that you're a seasoned entrepreneur. You have successfully expanded not one, but two businesses across the continent. Would you please let us know during this expansion and scale up, what was your most memorable moment?
Oh, wow. That's a tricky question because I have so many of them. I have quite a number of them. I think every time I travel to a country to launch a new team or a new office, that's always memorable. The most memorable feature, I would say, generally in business is to see people in the business getting to the next level, especially the level of leadership. I think for me it would be more of a feature than one single thing. The other feature that I love is I get to travel to these places and eat amazing food from all over. I'm a bit of a foodie these days. So it's perks of the trade, I guess. Yeah, I haven't fully answered your question, but I hope I've come close to what you wanted to achieve.
I believe you have. I'll go to Lois. Lois, if you could host a dinner party with one inspirational figure, past or present, to brainstorm innovative solutions for Africa, who would you invite and why?
Oh my goodness. That's a hard question, but I think I would host someone like President Obama. Because so being a policy person, I like looking at ideas that can create broad changes that everyone enjoys. That's the whole idea of policies. Like think about the least person possible. How can there be change for them in very basic public things, education, health, And so I would engage someone who has been involved in policy making and making really transformative ideas. So I would like to hear what Obama thinks we should do in Africa to get things better.
I believe we'd all want to attend that party. Then lastly to Dean. Dean, I believe that audience is very, very, very eager to find out, because we all know, based on the impact and insights you've given us, you seem like someone who enjoys reading and gaining knowledge. What book has the highest impact or the biggest impact in your career?
That's an interesting question. It's a startup book. It's not it's not good reading for people who are not deep into building tech startups, but I think it's still a really interesting one. It's called 0 to 1. And it primarily talks about how you bring together a small group of passionate people to solve potentially a big problem. Maybe now that I think about it, it has a few overlaps with maybe policy and scaling across markets. 0 to 1 by Peter Thiel is a really good one. And I found some of the structure and the wording can be a bit brutal, but the deeper message, I think, is really powerful in a lot of scenarios, especially when building a business.
Thank you, Dean. Then sadly, ladies and gentlemen, you're coming to the end. We have explored the immense potential of Africa's entrepreneurship spirit, the power of collaboration in the continent, and the potential of rethinking and reconfiguring how scale-up is being financed. Clearly, this session wasn't enough. We have tasked ourselves as Cassia Creek to plan for many more and continue this conversation. I want to give a big thank you to our speakers, Gilbert, Lois, and Dean. Thank you so much for your time, your incredible insights. You have really challenged us as aspiring SMEs and existing SMEs. Thank you for our participants for joining and for being awesome. Thank you for the engagement, the questions, and we are actually eager for you to actually continue following this conversation and engaging with Cassia Afrique through our social. You can find us on LinkedIn, X, and on our website at Cassia Afrique for more information, and also for you to get to see what we do in terms of our various pillars and how we are supporting the ecosystem. Together, let's continue to champion African business and build a better future for all. And thank you for joining us today. I am Rina, acting moderator for the day. Until next time, keep believing, keep building, and keep dreaming. Thank you.
Thank you, Rina. You're an awesome moderator. Claps for you.
Thank
All right.
you. Thank you.
Bye-bye.
Thank you. Bye.